Welcome to This Week on Wall Street, your essential briefing to what matters most in markets. I'm Matt Weinschenk, the Director of Research here at Stansberry Research, and in the next few minutes, I'm going to reveal exactly how you can spot major market shifts before they happen, giving you a crucial edge when others are panicking. And we'll also look at what's next for Trump's 90-day tariff pause. On Monday this week, markets rallied. A popular but anonymous X account known for quickly sharing headline news posted that President Donald Trump was considering a 90-day pause on tariffs. The S&P 500 surged higher on this news, but the White House quickly called the report fake news, and the market reversed course. On Tuesday, we saw a similar story. In the morning, the market rallied after Treasury Secretary Scott Bessent reported on constructive talks with Japan. So this gave investors hope that Trump was willing to negotiate on tariffs. But by midday, the White House confirmed it would raise its overall tariff rate on China. So the market cratered, losing 1.6% on the day after being up more than 4%. Then, on Wednesday, Trump did institute a 90-day pause on tariffs for dozens of U.S. trading partners, and the market ripped higher on what was now apparently real news. I'm not surprised. The early action this week made it incredibly clear. Tariffs make the market fall, tariff relief makes the market rise, and Trump couldn't stand the pain tariffs were causing any longer. I do have to say, while we've never claimed to understand Trump's mind or his master plan, we've followed this action well. On March 14th, I told readers that there is a Trump put, a point at which Trump would back down to rescue markets, even though his Treasury Secretary said there was not. The following week, I pointed out how damaging tariffs would be by driving the economy into a terrifying period of stagflation. And last week, I continued by pointing out that Trump's tariffs may lead to the end of America's financial empire. The market has backed up all of these claims as the tariff story has played out. And you can sign up to get that research for free at stansberrydigest.com. But the story here is simple. Tariffs destroy wealth and prosperity. I know my economics, and while I'll admit some lessons of the dismal science are open to debate, there's one thing that economics has proven to be true. Free markets are the key to unlocking the greatest wealth for all. Allowing individuals to pursue trade and profits leads to innovation and efficiencies that no other economic system can provide. Trade barriers, taxes, undue regulations, occupational licensing, and industrial policy all get in the way of the human impulse to build, trade, and grow. Trump's tariff policy was bound to run into that truth, and he didn't do himself any favors by implementing it in a self-destructive manner. The way tariffs took hold with extreme speed and confusing logic risked grinding global growth to a halt. And the messaging wasn't clear. Along the way, the White House claimed both that it designed the tariffs to bring countries to the table to make deals, and it also repeatedly said this is not a negotiating tactic. So putting tariffs in place so quickly was also counterproductive. Trump's entire goal was to boost American manufacturing, but as businesses struggled with tariffs on supplies and imports, it had the opposite effect. After all, if you want to build a factory, you need to import the machinery for it, or you have to wait years for that machinery to be built here. So the tariffs made manufacturing businesses less optimistic, not more. The Manufacturing Purchasing Managers Index for March showed an expected contraction in manufacturing activity, indicated by a reading under 50. And manufacturing executives reported that customers were pulling orders due to anxiety about tariffs. Now, keep in mind that survey is from March, which feels like a lifetime ago in the tariff saga. Now, what's not surprising is that Trump threw in the towel at the point of maximum pain for investors. There is a playbook for working through market crashes like this. By watching market dynamics, you can find patterns that may show you when the market may be bottoming. When you have a falling market, you want to find out when maximum pessimism hits. That's because stocks tend to turn back up after a cleansing panic sweeps through the market, exhausting all the sellers. We were hitting those panic points right when Trump decided he couldn't take anymore. Here's an indicator. Look at how many stocks had been hitting new lows. In this chart, you can see that the number of stocks at new 52-week lows on the New York Stock Exchange outpaced the number of stocks at new highs by more than 600. Over the past 30 years, that's second only to the dot-com crash, a clear sign of extreme pessimism. You can also see this by looking at the VIX index, which is sometimes referred to as the fear index. The VIX reflects the cost of insuring against stock losses. When the VIX is low, investors don't expect much volatility. And when the VIX is high, investors are fearful and options become more expensive. Specifically, when the VIX surges above 40 or so, that's a good indicator that the bottom is in. So these are clear signs that the market was at a point of peak pain, and Trump felt it too, and he took a pause. Now, we're all wondering what the playbook is for the next 90 days. When that clock runs out, does Trump revive tariffs at the level he threatened, making this a true pause? Or does he come in softer and slower with tariff rates, having taken a lesson from the market? I'm going to give you some valuable indicators to watch for clues as to what comes next. So first, you can get a pure reading on Trump's tariff plan by looking at betting odds. So this is a good minute-by-minute way to distill all the news into a single number. Betting platform Polymarket got huge publicity in 2024 when bettors on the platform properly called the U.S. presidential election before anyone else. And right now, you can bet on whether or not Trump will impose large tariffs in his first 6 months. So far, Polymarket has tracked Trump's mood well. Second, watch the stocks of automakers. They were clobbered by the tariff talk as automakers rely heavily on imports and exports. So if there's even a whisper of a rumor about tariff relief echoing through the halls of DC or Wall Street, you're going to see it in auto shares first. I'm going to monitor Ford, Volkswagen, and Toyota to keep track of automakers in the US, Europe, and Asia. Lastly, you should keep an eye on the US dollar. Currency markets are some of the most informed and most liquid markets in the world. The dollar will be a good barometer for two things: whether tariffs are going to come back and whether recent events have permanently damaged America's position as a magnet for capital. You can use either the US dollar index or the trade-weighted US dollar index to track the dollar's move. So, look, this is a tough market to navigate. There's no doubt about that. Buying the dip worked this week, but only because Trump backed down. If he had kept plowing ahead on tariffs, it's hard to find the case for long-term optimism. This is not our favorite climate for investing, but this is still a watch the headline sort of market until proven otherwise. That's why I wanted to bring in Mike DiBiase. He's got more than 28 years experience in finance and accounting, and more than a decade of that is here at Stansberry Research. He's a former CPA and Big Four auditor, and he's the editor of Stansberry Credit Opportunities, so he's always focused on risk. Mike, I know you're worried about this economy, and I know you have been for a few years now, but you still like to buy certain kinds of stock. If you're worried about recession and bear markets, why are you a stock buyer?
Well, first, you're right, Matt. I am very worried about the economy, and it's not just because of the recent tariff news. In fact, at the end of last year, my prediction that I wrote about was that the U.S. would enter a recession in the first half of 2025. In fact, I think we are already in one. I know most analysts don't agree with that assessment, but you're also right that there are certain kinds of stocks and investments that are great long-term investments almost all the time, no matter what your view of the economy might be. So I'm talking about businesses that have durable competitive advantages, pricing power, and that have high barriers to entry for competition. So these are the businesses that have products and services that customers love, and their brands tend to be so strong that they have inelastic demand, which means that companies can raise their prices and consumers will tend to still buy the same amount. So they don't see big drops in demand when prices go up, like they would with tariffs. Now, granted, you have to pay attention to valuation. You don't want to buy even the very best businesses when their valuations are so high that their future cash flows and prospects will never support them. So the way I see it is there's really two keys to being a great investor, and that is to first be able to identify those great, durable businesses, that have these great brands and reputations. And the second is to learn how to value businesses. So, you have to learn to buy these good and great businesses when they're relatively cheap. So with the recent pullback that we've seen in stocks, the correction and near bear market, we've seen some great businesses go on sale.
Yeah, owning productive assets is the secret to building wealth. Whether there's a recession ahead, there are businesses that can still profit and power through those. And we've been game planning the tariffs around the office now for a while. Now we have a 90-day reprieve, but they may be coming back. So what kind of stocks are you looking at in this little tariff window we have here?
Yeah, well, I'm looking for the kind of stocks I just talked about. But of course, President Trump's proposed tariffs change the investing landscape, the way that you have to think about things. It seems clear to me that Trump's main goal is to target China, to create a more balanced and fair trade with that country. But it also seems clear to me that Trump is a protectionist, and he's been talking that way for 30, 40 years. He wants to bring jobs back to the U.S., so I don't think he's going to abandon trying to develop more favorable trade with other countries too. So I think what we'll see is that the net result of all this is I think we're going to see higher tariffs across the board. Now, it's not probably nearly as big and dramatic as what Trump first proposed, but I still think we're going to see a material increase in tariffs with a lot of countries when this is all resolved. Trump is a negotiator, and he's using this to get what he wants. So that's how I view this is going to play out. We're going to have higher tariffs. So the question then is, how do you invest in this environment? Well, I definitely don't think you need to take all your money out of the market. I think that would be a mistake. But I do think that there's going to be a dramatic shift in global trade. But the important thing to understand is that the tariffs won't affect all businesses the same. In fact, even a recession, which I believe we're already in, won't affect all businesses the same. There's a lot of businesses that are somewhat resistant to recessions. And so those are the kinds of businesses I think that you need to look for. Specifically, I think you should avoid U.S. companies that import a lot of their goods into the U.S. and also that U.S. companies that export most of their goods and their products overseas, because I think we are going to see some retaliatory tariffs from these other countries. So that means that you need to look for companies that source, make, and sell their products almost entirely in the U.S. Now, there's not a lot of companies that meet that criteria, but there are some. The next option would be to look for companies that manufacture and sell most of their products outside of the U.S. And that's where something that we publish here at Stansberry Research called the Global Elite Monitor comes in. It's a list of around 140 of the world's best businesses, regardless of where they're headquartered. And around 60% of those companies are headquartered outside of the U.S. So it's a good starting point to look for these types of businesses.
So you're starting with the best businesses, and you're making sure their products don't cross the U.S. border, whether they're are bought and are made and sold overseas, or whether they're made and sold just in the U.S. What sort of industries did that lead you to?
Well, the first thing I think that investors should pay attention to is companies that don't sell products, that sell services that won't be exposed to the high tariffs. I love Alphabet, for example, Meta Platforms, American Express, Bookings Holdings, the travel bookings company. These are, technology companies, who don't have products that are going to be taxed. So I think those companies are going to do well. So we've seen pullbacks in their stocks, north of 20%. So I think it's a good time to put them on your shopping list. But then, there's companies that are truly mostly U.S.-centric companies. I'll give you a few names there that I like. Campbell's Company, it's maker of Campbell's Soups, Pepperidge Farm brand products, Swanson's, Prego. Most of their sales are in the U.S. I think it's close to 95% of their sales are in the U.S. Domino's Pizza, of course, famous pizza maker. Clorox is another one that we've seen most of their sales are in the U.S., and they're going to have, I think, a limited impact with the increase in tariffs. Now, on the other hand, for companies that sell most of their products outside of the U.S., I'm looking for companies that sell recession-resistant products. So a couple of names that I really love there are beer makers Anheuser-Busch and Heineken. Those companies have been around for a long, long time. They've survived World War I, World War II, the Prohibition in the U.S., and between the two of them, they own the three most valuable beer brands in the world. Anheuser-Busch's Budweiser, of course, and Corona, and Heineken's flagship Heineken brand. Most of Anheuser-Busch's beer that's sold in the U.S. is brewed in the U.S. I think about 35% of their sales are in the U.S., but most of that beer is brewed in the U.S., so it won't be subject to high tariffs. Heineken does have some exposure to tariffs, but I think a smaller percentage of their sales are overseas, and it has breweries in over 160 countries across the world, so it can shift production as needed. And most importantly, they're great brands, and it sells a product, beer, that is very inelastic in demand. So I think people will continue to buy beer regardless of whether prices go up slightly and also whether we're in a recession. Also, tobacco companies. There's some great international tobacco companies. I love British American Tobacco. That stock is really cheap today. I think around close to half their sales are in the U.S. So a name that I even like better than British American is Philip Morris. Philip Morris, none of their sales are in the U.S. So they do about $35 billion a year in sales, and it's all outside of the U.S. And Philip Morris owns the licensing rights to the #1 cigarette brand in the world, Marlboro. And I think Marlboro pulls in close to 40% of their sales each year. So that stock's also very cheap and has very limited exposure to higher tariffs. I also look for consumer staples. Consumer staples are things that people are going to buy regardless of a recession. So there I'm looking for names like Colgate-Palmolive, Unilever, and Nestle. They're great European brands that have brands that you've heard of and sell all across the globe and have some exposure to the U.S., but it's relatively limited.
Well, Mike, let me tell you, this feels like such a difficult time for investing. You got the threat of a recession. You got these tariffs that are going to upend the global order. But I think you've shown by digging in, you found an incredible watch list for the next 90 days. You've got staples that are recession resistant, and they're not crossing borders. So our Global Elite watch list is always available to our readers. It's a handful of outstanding businesses. Mike, thanks for digging in on the way those businesses cross borders. Folks, you can use that as their watch list for the next 90 days. And at Stansberry Research, we produce tons of free, high-quality research about so many investment opportunities. You can sign up completely for free at stansberrydigest.com. Of course, like and subscribe to stay up to date with all our market insights. Mike, thank you for joining us, and that is all for today. I'll be back next week.